Well, here in Spain, it's the turn of Chris McCann from Blevins Franks to join us today. How are you doing, Chris?
I'm very well, thanks, Howard. Yourself?
I'm very well indeed. Mind you,
Excellent.
we're all living longer these days, which sounds like good news. But the question is, can we and the state afford it? So today, Chris and I are going to look at the financial implications of longevity and what steps we can take now to ensure our money lasts as long as we do. So let's stand back and look at the big picture. What impact does longevity have on the state's finances?
Well, Howard, we're currently seeing two important demographic trends which are exerting a substantial impact on society and the economy. Firstly, a shift in the length of life, defined as longevity. And secondly, a rising proportion of older people, otherwise known as an aging society. In 1950, there were roughly 130 million people aged 65 and over in the world. By 2015, the size of this age cohort had grown fivefold to reach 600 million globally. And this number, according to the United Nations, is set to expand further to nearly 1.6 billion by 2050. The scale of the challenge that an ageing society represents is usually measured by the old age dependency ratio, which represents the proportion of people aged 65 years or older relative to those of working age. In the UK, this measure rose from around 10% in 1922 to nearly 30% currently. The increase creates two major policy concerns for governments. One concern is that a fall in the proportion of the population who are working age will lead to a decline in employment rates and so to lower economic growth. The second concern is that such a change will lead to an increase in expenditure on pensions and healthcare and a rising level of government debt. Public pensions are still the main source of income for the over 65s across the world. In the US and UK, public provision replaces around 40% of previous earnings, but in some European countries it can be 80% or more. Where it makes up a big share of total pension income, a shrinking workforce will increasingly struggle to finance a bulging group of pensioners. In addition, many people simply do not save enough. Roughly 40% of Americans approach retirement with no savings at all. And in the UK, 20% of women and 12% of men between 55 and 65 have no retirement savings. This being the case, more people have become more dependent upon government, and as a result, borrowing and government debt in most major economies have risen to historically high levels.
Government finances have been hit hard over recent years, with the pandemic swiftly followed by inflation and energy rises. How are our governments going to pay for all this?
In truth, it's going to be difficult. Most countries' public finances have been hugely affected by the economic shock of the coronavirus pandemic. Governments have spent billions to fight coronavirus and protect their economies, and lockdowns reduced the amount of money that governments raised in taxes. The energy crisis and rising inflation have only compounded the situation that governments find themselves in. Rising prices means that government revenue, collected in the form of taxes, does not keep pace with the cost of providing goods and services to the public, and make it more expensive for governments to borrow money, as lenders have demanded higher interest rates to compensate for the increased risk of inflation eroding the value of their loans. Governments have a few options to pay for increased expenses during difficult times. One option is to borrow money by issuing bonds, which are essentially loans that are paid back over time with interest. Another option is to raise taxes to increase revenue. Additionally, governments may make cuts to certain programs or initiatives to reduce spending. To date, governments have borrowed huge sums of money, and until recently, this additional borrowing had been affordable because of relatively low interest rates and inflation. Unfortunately, given current debt levels, higher inflation and higher interest rates, governments cannot keep borrowing, as Kwasi Kwarteng and Liz Truss discovered very recently. Instead, governments will be forced to either cut spending or increase taxes.
What's your advice to retired expatriates? How should they protect themselves from higher taxes?
For most of our clients, in a climate of rising taxes, and with tax authorities more focused on the collection of taxes, a major benefit of the advice that we provide are the resultant legal and legitimate tax savings. Despite the availability of ways to reduce one's tax liabilities in Spain, many people still fail to take advantage and unknowingly end up paying more than they should. This may include tax on investment income, capital gains when selling investments, and tax on their overall wealth. Many British expatriates are typically caught out by not reviewing their arrangements for their lives abroad. Once you are no longer resident in the UK, certain assets that were tax efficient in the UK, such as ISAs and UK investment bonds, become fully liable to tax in Spain. It's also worth noting that further to the UK's exit from the EU, the tax burden could potentially increase in some cases, as UK assets will no longer qualify for any preferable tax treatment given to EU assets. My advice to any listeners that have not yet investigated how they might improve their tax positions in Spain should invest an hour or two of their time meeting with a local Blevins Franks partner to learn more about what is possible. There's no cost for an initial chat, and it might result in significant savings for many years to come.
Moving on now to the big topic of 2022, inflation. The longer we live, the longer we need our savings to last, so inflation must be a big concern here. Can we breathe a sigh of relief when inflation drops back to normal levels?
I imagine that we're all getting used to the headlines about rising inflation, and the levels we saw in 2022 are certainly an eye-opener on how it can impact our living costs, our lives and our living costs. This follows 10 years of benign, easy-to-ignore inflation, but in fact, we were not immune from it then. It's always there in the shadows, slowly eroding the spending power of the euro in our pockets. So while suddenly everyone is worried about inflation, we should always be vigilant about how it impacts our financial security through retirement. It becomes a greater concern over time, and we are living longer. Although this inflation surge is lasting considerably longer than first anticipated, it is not expected to be long-term. We cannot predict what inflation will be in 10 or 20 years' time, but we do know that even low levels can seriously reduce your spending power over time if your money does not grow at the same rate.
Many retired people favour low-risk, supposedly safer investments such as bank deposits. But could being very cautious backfire?
Yeah, the problem with holding too much of one's wealth as cash is that whilst interest rates have risen, they are still at relatively low levels. And even as central banks increase interest rates, the retail banks are slow to pass on these interest rates rises to savers. So if you are holding significant cash balances, considering current rates of inflation, you're likely generating returns that are still close to zero, if not negative. Many retirees favour low-risk, safer investments, in inverted commas, like bank deposits in their later years, but with a potential 30 years or more to fund in retirement, this can be a risky strategy. If you're retiring now at age 60, you need to plan for over 30 years of retirement. And unless your savings grow each year, they will buy you considerably less as the years go by. As a basic illustration, if you have €50,000 in a current account with no growth and inflation at 3% every year, after 10 years, its value will have fallen to around €37,000. After 20 years, it's around €27,500, and after 30, just €20,555. That's a 59% reduction in your purchasing power.
So what steps can we take to beat inflation, but without taking on too much risk?
No one is immune from inflation, and we all need to plan to protect our savings and future income from the rising cost of living. Making sure your money lasts as long as we do should be an integral part of our financial planning for retirement. Firstly, we suggest that listeners look at their existing financial affairs and ask themselves if they're confident that they are suitably structured to provide protection from the very damaging effects of higher inflation. In simple terms, if you want the returns on your savings to outstrip inflation, you need to invest in assets that have historically generated returns that have been in excess of inflation. Given that bank accounts can be hard hit by inflation, your investment portfolio needs to comprise exposure to equities and real assets. At Blevins Franks, when we build a portfolio to beat inflation, we follow a simple, disciplined process. The first step is to agree what your objectives are. The second step is to agree upon a plan to achieve your objectives. And the last piece of the puzzle is to decide upon a suitable, well-diversified portfolio to achieve your plan and ultimately your objectives. As a part of this process, from a risk point of view, we take each client through an academically designed suitability process, which helps us to determine their attitude to risk. With this information, we can then ensure that they have the potential to generate the returns they require to achieve their objectives, but also ensure that they do not take too much risk. Having put the plan in place, it's then essential to have good quality investment managers to make investment decisions on a day-to-day basis, and it's also essential to have a trusted advisor, such as Blevins Franks, to ensure that you're patient and you stick to the plan, regardless of what happens out there in the world. If any listeners would like to learn a little more about our approach, they simply need to contact one of our local partners.
Our pensions are obviously important for our financial security. Should we review our pensions to see if we can improve our income, but without risking our capital?
As there are likely to be ways for expatriates to make their pension funds go further, I always recommend reviewing your pensions. As pensions are often the key to financial security in retirement, it's important to consider all your options, to carefully weigh up the pros and cons. You should also assess your income needs, investment options, currency risk, tax implications, and what happens to the balance when you die. The bottom line is that pensions is a complex area with some pitfalls not immediately visible and one to seek expert advice on. Blevins Franks has a team of pension specialists who support our advisors living locally. We have more than 45 years experience helping British expatriates make the most of their pensions while living abroad. So if any listeners believe a review of their pensions might be beneficial, they simply need to contact us.
And the website is a fount of information.
It is indeed. Listeners can visit our website, blevinsfranks.com, where they will find much more information about all the topics we talk about here on the radio. They may also complete a contact form on the website, and if they do, somebody from Blevins Franks will be in touch as soon as possible with the most appropriate next steps.
Many thanks, Chris. Always a pleasure. We'll talk again in a fortnight.
I look forward to it, Howard. Thank you very much. Bye for now.